What's up, guys? This is Ace of Trades here, coming at you with a brand new video. This video is on selling puts. We've already covered buying calls and buying puts. Now we're moving on to selling puts. What even are puts? Well, if you don't know what puts are, you don't need to watch this video yet. I go over what they are in my last video on buying puts. That video will be linked in a description, and I encourage you to watch that first before watching this video. So now, what exactly happens when you sell a put? Well, when you sell a put, you're selling the right to sell a stock at a strike price by a set date, which is, of course, the expiration date. So, in other words, you, as the put seller, are taking on the responsibility to buy the stock at the strike price if it is trading for under that price at the end of the day on expiration. Assignment. That's a very important thing to know. Assignment is when the person who you sold your contract to exercises their right to sell 100 shares for the strike price. It is now when you pay the strike price for these shares and buy the stock. And normally that will be on your last day, but technically they can do that at any time. But like I said, normally that will occur on expiration day. Warning. Just because a stock drops under a strike price does not mean it's immediately assigned. This is something that's a very common misconception. But you do have to remember that if you own that put, would you give up all your extrinsic value and sell before you had to? Of course not. You would never exercise your right, except for very certain circumstances before expiration date. So just because you have a $9 put that you sold and it dips to $8.99, that does not mean that it will be assigned right away. So I have put together 4 categories of put selling. They're also kind of like 4 reasons. So the first one we're going to talk about is closing. Closing is the category you use when you already own the put and you're just ready to close out your position. So instead of exercising, you would sell and collect some remaining extrinsic value as well as any intrinsic value you have. And that will allow you to lock in profits or cut your losses. This is only used for when you already own the put. The next one is cash secured. This is where you sell a put that you don't already own and take on the responsibility of buying 100 shares for the strike price, and you have the cash collateral in your account. Now, if you don't know what collateral is, it's simply the amount of money necessary to buy 100 shares at your strike price. So like if your strike price is $10, your collateral will be $100. If the strike price is $100, your collateral will be $10,000. And I messed up my math on the 10, but you get the idea. It's 100 times the strike price. Your broker will normally not allow you to use this money for other investments or for withdrawals. So please be aware of that. Now the next one is naked. This is selling a uncovered or unsecured put. This occurs when you don't have the collateral in your account necessary to buy the 100 shares for the strike price. This can result in a bad thing called a margin call and is one of the riskiest moves you can make in all of the stock market. However, with all that risk comes the highest potential profits whenever you're selling puts. Here's another warning, and I can't stress this enough. This strategy is so risky, Robinhood will not even allow you to do it on their platform. I reiterate one last time, this is a very, very risky strategy. Now the next one and final one is put secured. That's where you own a put at a different strike price, and if it's higher, you have to pay money for the spread, because when you own two or more, it's called a spread, and if it's lower, you get paid for the spread. But if the strike price of the one you sold is higher than the one that you bought, then in that case, you do have to put cash collateral down, but it's often used as like a hedge. So like, if you sell the $100 put, you may buy the $90 put, so you won't lose $10,000 if it tanks and goes bankrupt for some reason. You lose $1,000, and you give back just a little bit of the premium, and that creates a credit spread. The other alternative is a debit spread, which is a whole another strategy in and of itself, and we'll have a full video covering spreads and all the stuff you can do with it. It's very exciting, really. Now, here's an example of a cash secured put you're selling. At the end of the trading day in mid-December, Zynga, ticker symbol ZNGA, is trading for $9.12. Puts with a strike price of $9, expiring January 8th, are trading for 32 cents, which, just like when you're buying, is multiplied by 100. So your total credit will be $32. You can spend that money. That is yours. You can invest into Zynga shares or any other thing. That $32 is yours to have. Now, just doing the math, which is, in this case, the strike minus the price of the contract per share equals break even, which in this case is 9 minus 32 cents, which equals $8.68 as your break even. Formula for collateral, like I've already said, is your strike times 100. Since it's 9 times 100, that'd be $900 you have to keep as collateral. Therefore, your break even is going to be $8.68. If Zynga's trading above $8.69, you will make a profit right away. If it's below that, you will have a loss. But unlike when buying calls, and I'll get more on this in a minute, you don't necessarily have to realize losses immediately once you get assigned. But here's some different possible expiration scenarios. So say the stock price rises to $13. It went above your $9 strike, so you did not get assigned, and you walk away $32 of free cash. Now say it's $9. Zynga actually goes down. It goes down. But it doesn't dip under your strike price. It's trading at your strike price. Therefore, you still walk away $32 richer. Now let's say it goes down to $8.70. You still make a profit. You get assigned. You now own 100 shares that you paid $900 for. But you got paid $32 or to buy at $9. Therefore, you're walking away with a $2 profit. However, you will be owning $870 in shares and then $32 in cash. Now, let's say it tanks, goes to $5. You were dead wrong about Zynga. Your break even was $8.68. You now own 100 shares, which are now worth only $5, and you'd be looking at a loss of $368. You will still have your $32 in cash. You would just have shares worth a lesser amount. The thing is about it with selling is you can never make more than you sold the contract for. You can choose to close the contract early, just like when When you're buying, you can choose to sell early. You can choose to buy back early. And that's how you close out a put that you sold. Now, if the stock is trading under your strike price at expiration, you will now own 100 shares. So even if it's trading above your break even, but if it's under your strike, you will now own 100 shares. If your put expires worthless, or you buy back your put, then your $900 of collateral, in this case, is immediately released. Here's some of the risks and benefits of selling cash secured puts. Risk. You can lose a lot more than you can make. If Zynga crashes down to $1, well, guess what? You get that $32, but you're taking an $800 loss on your shares. So you can definitely lose a lot more than you can make. Regardless of what happens, as long as you have that contract open, then you are required to buy the stock at the strike price. Alright? So, like, even if it goes bankrupt, it halts trading because of some kind of accounting scandal, you still got to pay at your strike price. With that being said, though, if it goes to $100 and your strike is $9, well, the person who bought that put sure ain't selling for $9. He's writing his profit selling at $100. You would still keep your $32, but you would miss out on all those gains. Collateral requires money to be held on the sidelines. That $900 can't do squat for you while it's sitting around in your account being held as collateral. The only thing it can do is, like on Robinhood, they pay 0.3% annual interest. It can earn that, but that's it. Gains are capped fairly low. Now, you can get higher gains by selling at higher strikes. So, like, you can sell like a $20 Zynga put, get like a $1,000 paid to you on the spot. But your percentage of premium drops as far as the break even. Therefore, you would be looking at a higher chance of fail if you want to risk it for greater gains. Now, over on the benefits, we have, if the stock stays flat, you make money. If you own the stock and it doesn't move, you ain't making no money. If you own the calls and it doesn't move, you're losing money. If you sold the put, you're making that $32 if it stays flat. If you get assigned, you own the shares. That's another benefit. Therefore, you don't have to sell as soon as it expires. So, like, say Zynga goes down to, let's say, $8.50, and you still think it's going to go back up. Well, you don't have to just go around selling a loss for $8.50. You can hold that and hope it goes up and make money if it does. You know how I said it's one of the risks and bad things about buying puts or buying calls, either one, was that as time passes, you lose money if it stays flat? Well, guess what? You sold them that. Therefore, you're making money as time goes away. Like, for example, with Home Depot. It's trading at about $270 right now. It was trading at about $270 a couple of weeks ago. Well, guess what? My options are down like $200. Alright? That's money that the seller is collecting, even though the stock hasn't moved much at all. If you want to buy the stock, and this is one of the golden benefits, a lot of people only sell cash secured puts when they're trying to do this. But let's say you like Zynga. Alright? But you think it's a little high right now. You think $9 would be a good entry point. You could just sit on your butt and wait and wait and wait and wait to see if Zynga's going to drop to $9. And then if it does, you can snatch it up. Or you can sell puts, and you can still wait and wait and wait for it to go down to $9. but you can collect money while you're waiting. And then, let's say you do get assigned, but if you like Zynga at $9, somebody's paying you to buy at $9, even though you like it at $9. You can't beat this. You can't beat this. Now, comparing it to selling puts, to buying the calls. Alright, so on this chart, I did a little comparison. Buying the $9.50 call, selling the $9 put. As you can see, there is a point on this chart where you are making money while selling that $9 put and losing money while you're holding that $9.50 call. Let's do a little math right quick. So let's say it goes down to $5. Well, guess what? You just lost $368 by selling that put. But that's okay because you own the shares. So you still have a chance to recover that funds. All is not lost. Meanwhile, you would have only been losing the $25 that you paid to enter that $9.50 call. With that being said, that money's gone. That ain't coming back. You don't have anything left once that expires. But when you sell the put, you do still have equity left. Now, there's a little crossover that occurs, and it occurs at around roughly like 8.50 or so. To be better to sell the put, have that instead of buying the $9.50 call, because, for example, $9 stays flat, goes down a little bit, you're making $32 by selling that put. But if you bought the call, your $25 is gone. Now, though, you will see once it gets to $10, it's still slightly better to own the put or to sell the put, because you're making 32 versus only making 25. But once it gets over $10.07, it would be better to own the call, as you would still be making $32 even if it went to 100. But as you can see, like at 14, you'd be making $4.25, or at 15 you'd be making $5.25 if you just bought that call. But it's probably not going to go to 15. So you take advantage of people who want to avoid some crazy downside and wants a lot of upside. Meanwhile, you take advantage of knowing that that stock's probably not going to move that much, and you collect the premium. And that's how you make theta your friend rather than your worst enemy. Now, my next video is going to be out sooner than this one came out. It's on selling calls. I'm sorry it took me so long. I've been pretty busy with school, and I got the corona, so you know how that goes. But I'm back, and my next video will be on selling calls. Please go ahead and subscribe, thumb up this video. Thank you for watching. Just a quick disclaimer, I'm not a financial advisor. Please do your own research and consult a licensed financial advisor before investing. But thank you for watching. I'll see you next time.